Hello, so in this video, I want to show you how to trade the M and W pattern with understanding. It's easy to trade these patterns, but if you trade them in the wrong way, you could easily get fake outs in the market. That's why you'll come across someone doing the right analysis. You're able to spot the M, the W pattern, but when you take the trade, you still lose money. So I want to teach you to trade the M and W pattern in the very correct way to make sure that you increase your chances of winning whenever trading these patterns. Ideally, this is how the M and W patterns look like. This is the M, this is the W. So in this video, I'm just going to start with the M pattern. So I'm going to focus on the M pattern and first teach you how you trade the M pattern. So this is how the M pattern looks like. So when trading the M pattern, first of all, the whole concept of this high probability setup is that you want to apply confluence trading, or rather, you want to apply confluence in your analysis before you take the trade. In other words, when we talk of confluence trading, we are basically talking about combining several aspects of technical analysis to increase your winning chances. Because when you trade an M pattern, there are chances that you could make money, there are chances that you could lose money when trading the pattern. So how do you increase your probabilities such that you're able to identify that this M pattern is likely to be a more valid setup as compared to the other? And the answer is simple. You apply confluence trading in your analysis. So you combine several aspects of analysis before you take your trade using the M pattern. It's important to know that the M pattern is a bearish reversal pattern. What that means is that the market has been in a bullish trend, or rather price has been buying for a while. And when the M pattern forms, it's a sign of a bearish reversal incoming. So from being bullish, we now want the market to be bearish. The whole concept of trading the M pattern, we have two ways that you could get your entry with the M pattern. The first way is that here at the center of the M pattern, you mark the center. The center is called a neckline. So you could mark your neckline. And the concept is that you anticipate price to make a retest to the neckline. So when price makes a retest to the neckline, you could get your trade here now as a bearish trade and expect price to drop further. The other concept is that because it's not at all times that price will always retest the neckline. The other concept is that instead of price making a retest, price could easily just form a consolidation pattern. Then after the consolidation pattern, we could get a breakout to the downside. So that's the concept of trading an M pattern. Let's go to the live chart and see how we're able to apply the concept. Just taking this USD CHF, I want you to identify that we have an M pattern at this point. If you draw your pathway from here, because the other name of an M pattern is a double top, so you have your M pattern which formed there. So this is a sign that price is about to be bearish. So let's see how we apply confluence, because we want to apply other aspects to confirm whether this M pattern is valid. So I'll just come and draw something like a rectangle or square to just mark this zone. So I want to use top-down analysis to validate my M pattern, because I'm trying to anticipate after the M pattern, we're going to get a bearish reversal, meaning price is supposed to sell. But remember, some M patterns could be fake out. So we want to validate this using top-down analysis. So we're going to start with the higher time frame. And based on the marked zone, I'm going to look at the daily time frame and see whether I'm going to get any solid confirmation that USDCHF was bearish at that particular point. So when you zoom in at that particular point where we have our M pattern, I want you to be able to see that price has been in a bullish trend for a long time. After the bullish trend, price comes and forms a spinning top here. The spinning top candlestick is a sign that the bulls are now becoming weaker. So from the bullish momentum, we now have weak buyers in this market. So when you have weak buyers, it's a good time to anticipate that sellers might be in control. Looking at the next candlestick, it's also a spinning top in some way. It's also confirming that buyers are weak, because if you look at the candlestick, we had a strong rejection to the upside because of the upside shadow. So it indicates that buyers are weak. So we have two candlesticks each confirming to us that buyers are weak. So we are anticipating that sellers are going to become strong in this market. So let's see how the next candlestick plays out. Looking carefully, the next candlestick is actually a long bearish candlestick. And a long bearish candlestick signifies strong bearish momentum. So the first two candlesticks show us that the buyers are weak. Then we anticipate strong sellers, and this candlestick confirms that sellers are strong. So after knowing this, we want to go to the 1 hour time frame or any lower time frame to now get our setup. So the higher time frame, which is the daily time frame, has already confirmed to us that sellers are becoming strong in this market. So we are looking for a sell setup in this market. Having known that, we move to the 1 hour time frame. Remember, in top-down analysis, we are only using the higher time frame for confirmation of the general market direction. So the higher time frame already confirms to us that we are anticipating sellers to be strong in this market. So we now move to the lower time frame to now get our setup, which will confirm our entry. So going back to the marked zone, which is here, we now go back to the M pattern that we had initially drawn. This is our M pattern. So the M pattern, remember, we have two ways, as I earlier mentioned. Either price will make a retest to the neckline, or price will form a consolidation, then we get a bearish breakout. So in this case, we never got a proper retest, because if you mark the neckline, this is the center, which is the middle part. If you mark the neckline, price tried to retest, but it didn't get to that point. But it's also important to know that price won't exactly play out, the way you want. So price made a retest, but it didn't get exactly to the neckline. So what happens is that you anticipate a sell trend, but you want any valid reason before you can confirm that sellers are strong. So in this case, price made a very huge drop here. And if you check carefully, price dropped this previous low, because this previous low is now acting as our new neckline. So this candlestick breaks below this previous low, confirming that we now have bearish momentum. So in this case, we want to wait for price again to go back and retest, because it's already tried retesting. It failed to get to the neckline. So we are just watching the possibility until we get confirmation that bears are strong. Then this candlestick closes below this new low. Normally, this long candlestick acts as a confirmation, but the only problem with this candlestick is, for example, with my style of trading, if I am to take a short position with this candlestick, my stop loss will have to be very big, because I'll put my stop loss above the candlestick, and that's about 70 pips. 70 pips stop loss on USD is not realistic at all, because this price never made a retest. If at all price retested this neckline, we could have taken our sell trade here. But price never retested, so again, we haven't gotten into our trade at this point. So we continue watching until we get a better entry. So if you watch, after a while, price started forming small body candlesticks. So these small body candlesticks, if you mark them in some way, they can act as a consolidation, because price is behaving in the very same way. You see, we have a series of very small body candlesticks, which show that price has indecision, or we have weak momentum. So these sellers, the momentum of the sellers is now a little bit weaker. So we want to get a breakout along, a strong bearish candlestick, which will confirm to us that sellers are now back in control. Of which, after a while, we got this candlestick. And this candlestick is now realistic, because if you look at this candlestick here, if you take your short position there and you put your stop loss above the candlestick, it now makes sense, because it's exactly about 33, 35 pips, which is very realistic. Then the trade dropped all the way over 130 pips. It dropped even further, but this was the immediate trade that we took using the M pattern. A quick recap of the trade is, we remember that we started from the daily time frame, which is a higher time frame. So we were able to identify the market direction from the daily time frame. We then lowered entry to the 1 hour time frame, and we are able to identify that the market is in a reversal from the daily time frame, because at this point we missed the trade here, we missed the trade at this breakout, but we still had the confidence to take the trade here, simply because from the higher time frame we are anticipating a bearish reversal. So we are anticipating that USD should be dropping in the next couple of maybe days before we can go back to the bullish trend. So that's why we're able to take the sell trade here confidently. So the whole lesson is that you must back up your pattern with other solid factors. So don't just go for the M pattern and trade it blindly, because there are many M patterns that you can identify which will be fake outs. And if you just trade the M pattern because it's retested and you get a breakout and you take the sell, you could take a sell trade here and the market starts forming a bullish pattern and continues with the uptrend. So that's why it's important to combine other factors, which we call confluence trading, to support your trade before you can validate the pattern. So I'll show a second example, which is quite different in terms of the approach to the trade. First, we identify the M pattern. This is the M pattern. We have our first top, we have the neckline, second top, that's why we call it the double top. Then we have the complete M pattern. So we want to be able to identify the behavior of the market before we can validate our M pattern. If you look at price, we sort of have a downwards channel here. Price is forming lower highs and lower lows. Lower highs and lower lows, meaning that price is in a downtrend. So having known that, we want to just check the market structure, and I want you to spot something here very interesting from the. If you zoom out your chart, you'll actually realize that the general market direction is an uptrend, because if you zoom out your chart, you see that the price is forming higher highs and higher lows. But if you zoom in and focus to the specific point where we are trading, the zone where we are trading right now, you can easily tell that we have a retracement. So in this retracement, price has been forming a downtrend with the lower highs and lower lows. So this is the M pattern that we want to trade. Based on the past market behavior, price has been dropping, making a retracement. It drops even further. It retraces close to this previous high, but it didn't break the high. Then it drops, and we have a further retracement. So we just want to confirm that this retracement doesn't go above the previous high, because if it's a downtrend, then it has to be lower highs and lower lows. So we're going to mark the high. As usual, we focus on the candlestick body. You don't use the shadows. So if you check carefully, the body never closed above this previous high. So that's a good sign that our M pattern is valid at this point. So when we look at our M pattern, after the pattern has been formed, we come and look at the point in the middle, and we call it the neckline. You want to come and mark the neckline, and your anticipation is that price should retest the neckline, which in this case it did, because after price dropping, it retested the neckline, and after retesting the neckline, you want to get a valid confirmation that indeed sellers are strong before you get into your sell trade. So when price makes a retest to the neckline, you don't immediately sell at this point. You still want to get further confirmation, because the end goal of becoming profitable in Forex, I mean, before you even become profitable, you must be able to know that you have to deal with high probability setup. So you just don't trade because you feel like, or because you've seen a pattern. You don't trade with emotions. You must stick to the plan. And the plan is that we only focus on high probability setups, meaning we give our trades enough room to play around and give us enough confirmations before we can have the confidence to take the trade. So we get a retest, then we get a candlestick with a rejection to the upside, which confirms that indeed this retracement, the buyers in this retracement are now weak. So the retest is valid. Then after the candlestick, we get a bearish, strong bearish candlestick. So you could take your trade immediately here. Personally, I will never take a trade there because I like getting more confirmation. So what you can do also, you can come and mark this previous low now as your new neckline. So what you want is for price to come and break this neckline. So in this case, we got a breakout at this point. So this is a very good point to get into your trade after this candlestick closes. So you can easily come and take your short position there. stop loss of USDCHF not more than, I mean, at most 30 pips. In this case, 20 pips worked very well, and the price dropped over 100, I mean, over 70 pips. Eventually, it dropped further, but for this specific trade, we had a risk reward of about 1 to 3.6, which is quite good. So you first focus on the M pattern. You look for other factors to back up your trade. It must be solid. Just like in any other thing, you must have a foundation before you take your trade. Then you want to be patient enough and get enough confirmation. I had my first confirmation here with the rejection, second confirmation with this candlestick, then I had my third confirmation with this breakout of this new low, which is also the new neckline. That's where I took the trade. So that's how you trade an M pattern. Then we move to the W pattern. Concept is the same, this time just the opposite direction. It's also a reversal pattern, but instead of being bearish, we are now anticipating the market to reverse from being bearish to becoming bullish. This is how a W pattern looks like. I believe this time it will be easier for you to understand because you've already gone through the M pattern. We are gonna just show the concept first before we get into the analysis. As usual, we have two ways to get into the trade. The first way is that you mark the neckline. After marking the neckline, you anticipate price to make a retest to the neckline, something like that. After getting your retest, you want to get a confirmation somewhere around this area. Then you want to get a strong bullish momentum. The other way to trade your W pattern is that price won't make a retest, but we could get a consolidation of price, something like that. Then we could get breakout from the consolidation. So in this case, after this consolidation, you want to be able to spot your breakout first from the consolidation. After spotting the breakout is when you want to get into your trade and expect price to move further up. So both of them are a valid way to take the trade using the W pattern. But you see, there's a difference because here it was very simple, and this is one of the best ways to trade the W pattern because it's very simple. You see, after the W is formed, you get a retest, then you get a confirmation, and price moves further up. But in this case, we got a consolidation, which might be confusing because it's possible that after the consolidation, price could even come and retest first. So this is not the safest way to trade, but in case you get such a pattern, you also just follow up. And in the case that you get a strong breakout, you can get your trade there and expect price to move further upwards. We move to the real chart. First, remove the drawings. So first, I'll start by spotting the W pattern so that you can understand the whole basis of the analysis. So this is our W pattern. We had a first bottom. The other name of a W pattern is a double bottom. So that's the second bottom. And price made a push to the upside. So you can just drag this pattern here for you to confirm that it resembles it resembles a W pattern. So whenever we see this pattern, it signifies a bullish reversal. So that means price has been dropping for a while, but this pattern, we want now to get a bullish reversal to the upside. So just like the other analysis, we want to get other factors to back up our trade, right? So I'll start by trying to identify the current market structure of this pair AUD USD. We want to see what is price doing in the general. It's very easy for you to identify that this price is in an uptrend because price is forming higher highs and higher lows. So this is a very easy market to trade, especially if you already understand the structure. Price is forming higher highs and higher lows repeatedly. So what you're expecting here is that price is in a bullish trend. So when price is in a bullish trend, the best trades you want to be taking are bullish trades, right? So this is where our W pattern has been formed. So I want you to identify one thing. In a bullish trend, we have two types of move. We have the impulse move and the retracement. So at this point, we are having a retracement. So whenever we have a retracement, this is what you need to do. You need to always mark with the Fibonacci tool. So take your Fibonacci retracement tool, drag it from the previous low to the next high and extend it. And there's a video that I did on Fibonacci. I'll link the video in the description. So when the price is retracing, you want the retracement to end anywhere between the 50% to the 78%. This 0.5 level to this 78% level, because that means from anywhere in between these points, price has achieved what we call equilibrium. Because this retracement usually happens to form a market correction because price has been buying for a long time. So we'll just have a correction, then the price will continue to the direction of the trend. So after marking this zone, we want to look for anything significant to buy at this zone. It could be a pattern, it could be a consolidation and a breakout, it could be a rejection candlestick, but we want at least more than one confirmation for us to take our buy trade. So luckily at this particular point we got a W pattern, which is even a more solid confirmation. So I'm going to draw the W pattern here. So that's our W pattern. You can all see that. So after having a W pattern, remember the concept. You go and you mark your neckline. The neckline is this point at the mid. You want to mark your neckline. And the anticipation is that price could potentially retest the neckline, or we could get a consolidation and a breakout. And in this case, price played out perfectly because we got a retest to the neckline. And this retest was so perfect that it ended up closing with a very long rejection candlestick. You see this rejection to the downside, this long shadow represents strong rejection to the downside, because at one particular point during this 1 hour, price was dropping strongly, but by the time the 1 hour candlestick is closing, price has moved all the way back up and it even closes a bullish candlestick. That shows that the strong sellers were rejected, and if the sellers have been rejected, it now means they've been rejected by the buyers, because you only have two forces in the market. Either price is buying or selling, there is no other thing. So it means the sellers have been rejected by the buyers. So at this point, we can confirm that the buyers are strong. So here, I think this is good enough for confirmation because we already had the W, we had the retest to the neckline, and this retest was rejected by a very strong shadow. So this shadow is confirmation enough for us to get our buy trade. So you can take your long trade immediately after this candlestick closes bullish. You want to have your stop loss on AUDUSD somewhere above 25 to 30 pips. In this case, even 25 pips work because price never even dropped further to this zone. And price made an impulse move of about 147 pips, which is a risk reward of 1 to 5.75. So that's how you trade the W and M pattern. So the whole concept is the same. After identifying the pattern, get backup factors. If there is no factor to back up your trade, to solidify your trade, the pattern, then the pattern might be easily invalid. So to avoid fakeouts, look for other factors to support your trade, either from the higher time frame or from the general market structure, like in this case. Then get other confirmations, like in this case, our confirmation is this rejection candlestick and this candlestick closing as a bullish engulfing. So in that case, we're able to take our trade confidently, and you see the trade played out perfectly. So basically, that's how you trade the M and W pattern.